Righto, Money Miners, welcome back to another week. Bloody JD's in the Formula One hotel in Melbourne, dialing in. How are you, Cobber?
I'm doing well. Formula One hotel, that's a new one, mate.
Ricardinho, what do we got in store for the Money Miners? Bloody.
Hey, mate, I think we've got two. It's actually interesting. Our headline two stories are about companies that have non-controlling interests in joint ventures. One, there's an acquisition going on, and the other one, there could be an acquisition on the cards very shortly. These being, have you ever heard of Alumina Limited? It's the world's least interesting stock on the ASX with no appeal. And the other one, mate, Greatland Gold, not even on the ASX yet.
Mate, the Greatland Gold, the only bloody company that has their own dedicated chat group on the internet. I bloody love it. And Alumina, never heard of them, but they're being illuminated today, you'd say. Oh, what else? Any other bloody straggler of stories we've got?
Yeah, we're going to talk about Capstone Copper. These guys also very uninteresting in terms of the ASX. They've got a CDI listed here as of the beginning of the month. Hasn't traded a single share. So we're going to get into why as well as what the company's all about.
Very good. Now, the old bloody Jeremy Raper episode, what a ripper. The old long form that went out on the weekend. The punters absolutely loved it. It was bloody good. And, mate, we put the call out on that episode, boys, about companies that weren't using DSI. They're probably going to be on Jeremy Raper's hit list. VRIFY.
Yeah.
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 The same has to be done for DSI, I think.
Yes.
And like we've already expressed that because, mate, operations that aren't using DSI as a ground support provider, it's just inexcusable behaviour, and two, potentially exposing yourself to some shareholder activism from Jeremy Raper. So I
think it's unsafe.
It's not that it's unsafe, Trav. It's unsafe for your share price. We're not saying that it's unsafe for reliability of delivery. DSI they're the biggest name. They got the biggest facilities. You just know it's going to be there because the most unsafe thing about ground support is not putting it in.
Yeah.
So if it's not on site, if it's not in the bloody laydown yard, mate, there's nothing to put in there.
If you use someone else, it's like putting twisties in the ground.
Yeah, you know when you actually put a split set in and you put rotation on, which you're not allowed to do, but it's quicker to put it in. That's why I never had rotation on. It actually looks like a bloody twisty. It twists the bloody split set, so it doesn't work as good. Follow the DSI rules, turn rotation off. It is quicker when you use it. But anyway, mate, I'm telling you now, it's the global brand. It's just the global ground support brand. They're the biggest. They're the bloody best, mate. They got bloody mesh. They got every type of bloody mesh known to man and woman. Your normal bloody run-of-the-mill mesh, seismic mesh, bloody every bloody mesh. Millions of split sets, GUI bolts and MDX bolts, cable bolts, bloody portal sets. Oof. Mate, is there absolutely anything to support the backs and walls to make it safe for the world to go underground? I'd send me kids down under DSI ground support.
I think mine's
I'd let them walk down there.
If it wasn't for DSI, our mines would be about like 1/4 as deep.
Probably.
Yeah.
That could possibly be the case. They just would have stopped.
They would have stopped.
Mate, the Qdale factories expand, and as we said, go hit DSI up for a job if you want, mate. With expansion, Trav, comes opportunities.
It does.
Simple as that, mate. Just do the right thing. Stay off Jeremy Raper's hit list and make sure DSI is your ground support supplier. That is all I'm asking. And, mate, just speaking, K-Drill are just keeping the industry alive.
Yeah.
I reckon.
We're talking about Havieron today. K-Drill discovered that.
Of course they did. Of course they did. Could you imagine if another deposit was never discovered? That is the realistic. Now, I might sound like a harp on here, but that is a realistic possibility if you don't have K-Drill punching diamond, air core and RC holes in the bloody earth for you. That could happen. The world mining could stop.
Geos, right?
Exactly.
It
bloody.
is
I don't want if discoveries aren't made, the mining industry stops, and you don't have money to mine anymore. Like it's simple as that. So, mate. Customised hydraulic RC rig, safe as a bloody house in execution of exploration, these guys. Fun fact, Trav.
Tell me.
K-Drill have a 100% success rate of returning a positive assay if they intersect an ore body while drilling.
You want to know that.
You don't want a chance. What companies have a 100% success rate of doing anything in the world? I can't bugger all. except K-Drill. Like, because I would class Ryan O'Sullivan as probably the biggest name in exploration post-2000. Ryan O'Sullivan is exploration.
Who was before?
Boom.
Who was 2000?
I'd probably say Ronnie Sayers. He's the godfather of exploration in
Is he?
may he rest in peace. Yeah.
Yeah.
I think Ryan O'Sullivan post 2000, he is exploration. Boom. Simple as that. His email's in the show notes, mate. You can bloody get in touch with him. Get K-Drill punching holes into the ore body that you don't even know you have yet. Simple as that. Pretty much just if everyone follows what I say in these ads, your business will be better. Simple. Very simple. Ryan O'Sullivan has never let anyone down in his life, and he will not let you down if you get him and the K-Drill team on site to punch some bloody holes in. Simple as that.
Can't wait to see an investor presentation, turnaround strategy of our mining company. We are going to use all of Money of Mine's partners as our
That'd be a bloody good start. That'd be a bloody good start. Righto, JD.
Not rocket science either, hey? Not rocket science,
Can't spell it out to everyone any more than I'm doing now. God. Right. Bit of news last week out of Newmont, which is the new Crest and Newmont. Mate, the investment bankers, they'll be licking their lips lining up for the tickets here, boys. So new capital allocation strategy, a.k.a. we want to sell all our shit assets, intending to divest 6 non-core assets that don't, I guess, meet their tier 1 status that they're looking for.
Did you look at their definition of tier 1, Matty?
Yeah, so it's like, it has to be over 500,000 ounces per annum, X amount of mine life,
10 years,
and yada, yada, yada.
Yeah, and lowest half of the cost curve. Pretty good definition.
Yeah.
Because everyone uses the word bloody tier 1, and it's pretty loosely thrown around, don't you reckon?
No, I like it how you can have, if you don't have a tier 1 project, but you can have it in a tier 1 jurisdiction. Yeah, so that's all right. So what? There's 3 Canadian gold mines: Eleanor, Musselwhite, and Porcupine. Probably said all 3 of them wrong. Cripple Creek and Victor in the US. Achium in Ghana, Australia's Telfer mine, and then also for the project side, development project side, there's 70% stake in Havieron near Telfer and the Coffee Gold in Canada. So Perseus actually indicated that they're interested in buying the Achium project in Ghana. Mm-hmm. So, but the interesting one here, boys, which has got a chat group, which is great. So I'm going to get bloody slaughtered on there after this, no doubt. The Telfer and Havieron projects.
Yes.
So I'll go through a bit of a lay of the land and context of this Havieron-Telfer interaction.
Before you do that, Matty, I reckon it'd be even worth just saying, why is it bloody interesting that these assets are for sale? It's because the big gold mining companies that we have and we know about today, they built their businesses off the back of buying the divested assets from Newcrest, from the likes of Barrick, from these big miners.
Yeah, Northern Star.
Exactly.
Barrick, Newmont.
Yeah.
Evolution
did the same. Yeah. You know, I mean, that was kind of the strategy to create value, was you pick up the unloved assets from the bigger global miner and you operate them more lean, and then you create value for shareholders. And that was the success of Northern Star and Evolution in a lot of ways. So who's going to be the next bloody gold miner to do that?
Well, buddy, I reckon they operated Telfer lean far out. When I was there, the food was shit, and bloody you had to turn your air cons off during the day because they didn't have enough power. They were operating it lean. So we'll speak. It's funny because Sean Day runs Greatland Gold, for those who don't know, and he was the CFO at Northern Star when they went on that buying rampage for the Barrick assets, Jundee from Newmont. So obviously been there and done it for that side of things. So Telfer is 55K haul from Havieron. Mm-hmm. But Telfer has this bloody huge 26 million tonne per annum mill.
That's
bloody
massive.
Huge. It's numbers, the numbers are different everywhere I look. Greatland's PFS said it's 22. I've been told 26, but so it's something around there. Now it's 2 trains. So that means they can drop off a train and run it at 13 or 11 or 13 based on whatever number. So,
Gotcha.
But that's a bloody big mill. Fucking huge. So the challenge of that is keeping that fixed processing cost low and filling it. So, because the PFS was released for Havieron in 2021 by Newcrest, and that was part of their farm-in obligation, outlining a 2 million tonne per annum operation. It wasn't a knockout. So remember, Newcrest the way it is now, Newcrest owns 70% of Havieron, Greatland Gold own 30%.
And Newcrest were operators as part of that too, right?
Yeah.
So Greatland were kind of just at the whims of whatever Newcrest decisions were, which maybe, did they lowball the PFS numbers, Matty?
Well, the word on the decline, Rick Ardinio, was that, yes, Newcrest, I guess, lowballed this PFS to make the value of Greatland look a bit lower than it is, maybe. So, like, a takeout would have been a bit cheaper.
Yeah.
Pure word on the decline. So, look, word on the decline.
Yeah.
Essentially bloody gospel.
The gamesmanship makes sense.
Yeah, yeah. So, look, the numbers. CapEx was 529 million with an NPV of 304, so less than the ideal 1-to-1. And that's utilising the Telfer mill, not building their own mill, so hauling it to Telfer. But there were some Telfer mill modifications required, like a magnetic separation within the float circuit to reduce the amount of pyrrhotite in the final copper concentrate, because the Greatland is a gold copper deposit. As we know, copper no good in cyanide. I think there's flotation and stuff anywhere, but there was some modifications required. 16% IRR, so that's obviously not good. It was an 8-year mine life for 160,000 ounces per annum. So, but this was just for I'll bring up some pictures to show you what this bloody looks like. This was just for the higher grade southeast crescent zone. And that contains 4.8 million ounces of the total 8.4, which is in the resource, which was updated in the December just gone. So this high grade south crescent thing, it's like a little bloody U shape. It's like a C, I'd say, C. It's about a bit under 3 grams per tonne gold and 0.4% copper, but the remainder of the ounces in the resource are about 1 gram per tonne and 0.13% on the weighted average. So 83% of that's inferred, which is expected because it's bloody 1 kilometre odd deep.
If my memory serves me correctly, this is to speak to the gamesmanship between Greatland Gold and Newcrest over a long period of time. I'm pretty sure the two companies were putting out separate mineral resourse estimates on the same project because one wanted to understate it, the other one wanted to obviously overstate it. So, you just had kind of these parallel work streams on the same project and big gamesmanship.
You never really hear that mineral resource estimates being understated, do you? Except in situations like this.
You also got to the point in time where the way the farm-in was structured, you had all these various, stages where Newcrest had the option to buy an additional stake as the project progressed, and Newcrest got to the point where they decided not to engage and buy the next 5%. I think from memory, it was at like a $60 million price.
Yeah, I got it in here. Where is it? So it was they had the option to go up to 75% total ownership. I think it was for 60 million, but they declined.
That's what my memory was.
Yeah, so that was the sort of the first indication that things might be changing here. Now that case was for 2 million tonne per annum, so not bloody big. They were looking at then studying for a 3 million tonne per annum case after converting the inferred part of the resource, so that the Brescia zone and all this other area, which is the lower grade bit I was talking about. So because there was a DFS supposed to be coming out in December 2022, but then Newcrest delayed the study, said they wanted to further de-risk the project, and for that's at that time is when you said, JD, they could have bought another 5% for US 60 mil, but didn't take the option. But then remember, Twiggy's Wyloo, they come in and bought 8.45% of Greatland Gold just to make things interesting, and then also provided a standby $50 million debt facility in September last year. To my knowledge, that hasn't been drawn on, but it is sitting there because they've developed down 300 vertical metres so far, because the ore body starts at 430. They're currently dewatering the base of the aquifer they had to develop through, so the decline's on hold. I heard it's one of the most bloody expensive declines in history because that top 420 metres is Permian cover, which is in simple terms, real bloody shit ground.
Cover is, yeah.
It's bloody happened 300 million years ago. Bloody
Deep cover, but the size of the prize has got to be worthwhile to get there, which Havieron is, right?
Well, because they had to road header it. Like, it wasn't just conventional jumbo drill and blast. So, like, it was road header and a metric. Like, it's a road header. It's like a big it's like what they used in coal and everything. It's like a big rotating thing with these bloody bits on it that just cuts through it.
Wow.
And yeah, so they would have put a bloody metric fuck ton of ground support in to support that ground and everything. So
a few DSI orders.
Yeah. Oh mate, I'll bet a bloody check there's some bloody DSI bolts in there. I don't even know if there is bolts. It's just probably because if the ground's that shit, your bolts don't do anything. I don't know if it's just a heap of bloody shotcrete and thick like pretty much a bloody arch of cement around it. I'm not sure on that, what the support is. So this was interesting. They had 61 million on their latest prezzo in February 2024. They had this month. They had 61 million in cash and 81 million in debt, and so that debt was provided by Newmont, but that was as at 30 June last year. So obviously a bit of underground work, a lot of underground work was done, aquifer pumping. So I'd be interested to know how much cash they actually have left after their 30% worth of, because they had to contribute to their share of the decline development and growth drilling and all that. So be interested to see how much they've actually got left and if they've had to tap into bloody Wailu's $50 million standby facility.
How'd they end up with debt to Newmont?
It was part of that farm in
Right. Gotcha.
the Newcrest had put that in, then they actually lent them debt to fund their share of it as well, their 30% contribution.
So the drawn debt, the way I think about the drawn debt, and if they've drawn down any of the stuff with Wailu, is they talk about that ASX listing, but you'd hopefully clean up all that balance sheet stuff if there was an IPO.
Well, that was the talk last year, was waiting for this Greatland Gold IPO in Australia because they trade in, on the London Stock Exchange.
It might even be the AIM. Is it? Yeah, I think it's the second rate exchange.
Yeah, you might be right. That listing here has gone a bit quiet. There's articles in the Fin from a year ago. I think we spoke about it in May of last year, looking to raise 100 odd, but haven't heard a peep on that in quite a while now.
I mean, they were in a bit of a precarious situation because being at the whims of Newcrest and Newmont's timeline kind of sucks because they were so preoccupied, right? That as non-operators, how do you do an IPO and come to market and say, here's our strategy, here's what we want to do, but everyone is just like, well, you don't get to choose that. Newmont does. Do they even care about this? Do they want this? What are they going to do with this? Finally, we've got an answer. They want to bloody sell it, which is actually good news for Greatland. Yeah,
and it just looks like a bit of a tricky situation, a tricky deposit. Before I get into what the play is, so there's the high grade zone that looks like, it's just pretty simple. Go in, bloody, now that once they get down there, because it is 400 metres underground, decent gold and copper, they can mine that as a, whatever it is, 2 million tonne operation based on Newcrest's PFS. But then you got all these other sort of lower grade, bigger blobs everywhere. I'm not sure if it's all, doesn't look continuous based on the block model. I'll bring it up here, but look, I'm not sure because it's all deep drilling and everything. But they talk about, could you turn it in? It's obviously separated. Could you cave some of it? But then there's these aquifers that I think it was like 3 aquifers or something they had to go through developing it. So you start bloody block caving, then eventually it will, the cave will go to the surface. But then if you then break the aquifer, she's a bloody disaster because there's just water, infinite bloody amount of water that just pisses in. That's what happened at DeGrussa when I was there. You punched a bloody hole in the aquifer and she just flooded the whole joint until you blocked it up and pumped it out. So that's water like that can just end an operation. So it's that's why the PFS they put out is actually because you could do look like you could do some sort of caving operation with this higher grade zone, similar to what Big Bell does, because it's pretty thin, but you mightn't be able to because of the curve of it, but so how they do it is I'm not sure because of the risk of cave, whether you could start a cave down the bottom and hopefully it doesn't subside to that aquifer, not sure. But what's the play? There's obviously there's obviously a lot of gold at Telfer. It's bloody gold everywhere there. There's from what I've been told, there's a lot of smaller pits that could be started. There's underground areas that could be accessed. Like a lot of exploration being conducted over the years. It's like one of those dribs and drabs everywhere on a tenement that doesn't suit the likes of a Newmont. They don't want to be dealing with that shit. So, and you can see from the independent expert report from Newmont's takeover scheme, assuming it's independent, they valued Telfer and Newmont's stake in Havieron to be between 500 and 600 million. So it's like the midpoint of two scenarios. I'll bring the chart up here. But they haven't, as you said to me, Trav, they haven't separated what Havieron is worth. It's like what is Telfer and Havieron worth combined? So because there was two scenarios. The first one was pardon me, finishing mining the Telfer open pits to FY26, bit of underground at Telfer, and this PFS case for Havieron, just taking the high grade area. Second one is expanding Havieron to 3 million tonne per annum and then expanding the Telfer underground without actually finishing mining the open pit, which is declining in grade. So they said that actually that increasing Havieron to 3 million tonne and mining this Brescia ore body as well would add another 272 million of capex to the project. So, and you can see by the tonnages of each situation that they're battling to get over sort of 7 million tonne per annum. And remember, one train at Telfer is somewhere around 11 to 13 million tonne. So it sounds like it's a campaign mill jobby. And the rehab liabilities they've put to Telfer are $160 million, and they've got 105 for Havieron as well. So. If you consider the modifications required for the Telfer mill that they disclosed in the initial capex and the amount of dirt that you need to fill it, what's Greatland Gold's options? So there's a few, and feel free to add some. They can buy the Havieron stake off Newmont and then build their own mill. So you could save bloody hauling the dirt 55 Ks, avoid the Telfer rehab liability, put money into the new mill instead of modifying the Telfer mill.
And importantly, get a right size mill because it's...
Yeah, right size mill. Yep.
Yeah.
Exactly. But you wouldn't think that you'd think that Newmont would not want to sell that Havieron stake separately because that would make selling Telfer
so hard,
a lot less appealing.
So who would want to buy Telfer?
Who's going to want to buy Telfer with the rehab liability and the
short mine life?
They sort of nearly need to go. They have to go together, you'd think. Or another option, Greatland goes all in, buys Telfer and the Havieron stake off Newmont and does it all themselves. So based on that independent expert report number, the value of that deal would be possibly higher than Greatland's total market cap. So it'll be probably require a big bloody IPO in Australia, a lot of funding, similar to probably what we've seen with Mac the SPAC buying CSA. God, it could be like a $1.5 billion IPO or something.
And a deal like that could be structured in such a way where Newmont take scrip in the pro forma. You could do it so the funding gap didn't seem so horrendous. When you've got Wyloo kind of on the register as well, kind of you could put a deal together where you can see, the funding sort of come together. But there's a bit of work to do there.
Well, or you could have someone buy Greatland Gold right now and put themselves at the table to do a deal with Newmont. But remember, Newmont have a right of first refusal on the remaining Havieron stake that they don't own. That was in the initial agreement.
Newmont or Greatland?
Well, funny you say it. So it's Newmont have a right of first refusal for the remaining Havieron stake. That was disclosed in the farming agreement.
Yeah.
But then we've seen in the Greatland Gold chat forum, that's right, they've got a chat forum, bloody madness.
Big retail stuff.
Isn't it? What? Jesus Christ, I'm going to get crucified for this. There's comments about Greatland apparently also having a right of first refusal on the Newmont stake in the Havieron project.
Right of last refusal, they call it, which means
right of last
refusal. All the bids come in, then you get the last right to say, do I want to match that or not? Yeah.
Yeah, right. Yeah. So but I can't find anywhere besides a bloody internet chat group to confirm or deny this.
Yep. My gut feel is that the Greatland Gold do have a preemptive right, which basically gives, similar to when when IGO sold their 30% interest in Tropicana. Remember, Anglo Gold Ashanti had a right to match the bid from Regis, and they ultimately said, no, not going to match it because they've bloody paid to, they bid through the tits, and this one we don't want to match it. But they had the right. So if Greatland have a right for whatever bid comes in, then it gives them a pole position to match it and get 100%, and then be masters of their own fortune, which I'm guessing they've wanted to be for ages, but they as a non-controlling JV partner, they haven't had the ability to do that yet. So if some third party wanted to own Havieron, the pathway to do that is probably Greatland and then exercise the right.
Yeah, yeah. And buying Telfer gives them, like, it's not just the mill, it's the camp, the bloody, like, a lot of infrastructure there, along with just the mill. But yeah, who knows? Who knows if Wailu's going to get involved? Like, they must have took that stake for some reason. A lot of exploration potential around that Patterson region, but and there's other JVs they've got as well. So yes, will Wailu get involved? Will Greatland take the whole thing? Who knows? Hopefully it's bloody heating up, boys. We're going to be right here when it happens.
Maddie,
think about the soft issues if, you know, that last option you put on the table, if Greatland were to get taken out. Have you seen the Greatland board? It's it's a bit of a cream of the crop of relations to Andrew Forrest.
I know, Elizabeth Gaines on there.
Mark Barnaby, yes, buddy.
Mark Barnaby, yep, as it's pretty illustrious. So I wouldn't put too much stock in them getting taken out and all being put out of a nice board position.
Yeah, look forward to hearing from you all, Greatland Gold punters.
Hey, I've got one more fun fact for you, Matty. Did you know that Australia's largest tungsten resource, I'm pretty sure, is part of the Telfer package there?
Is it?
It's called O'Callaghan's. Yeah, it's not too far from the Telfer mill.
There you go.
So there might be a bloody tungsten spin out there.
Mate, you never know. It could be the next big thing, tungsten. You never bloody know. Yeah, we didn't mention as well, they had Telfer just paused operations recently for a crack in the tailings dam. So sounds like it's being remediated, or because they did restart operations, I think. So that'd be part of another liability as well. All right, boys, that's enough for me. What do we got next?
Deals.
Alumina and Alcoa.
Well, the first thing I want to start off with this one, guys, is, you know, the headline for me, there was another non-deal roadshow. What an absolute load of shit non-deal roadshows are. These guys were touring around. I think JP Morgan were taking them around at the beginning of the month. There is always a deal, whether it's a capital raise or M&A or whatever. These guys just don't seem to do non-deal roadshows, so that can, you know, put the alerters on if you ever see them going around. But let's get into the actual deal now.
Just on that, JD, we saw that, you know, notification, you know, less than a month ago that Alcoa was doing a non-deal roadshow on the east coast of Australia, and now ears pricked up straight away. Like, what's the deal? What's the deal? We're asking around. What's the deal? What's the deal? We couldn't figure it out because it's bloody Alumina and no one knows anything about it, and no one owns this stock, even though it's a $2.2 billion takeout. Like, literally no one, like, there is no coverage or even care about Alumina Limited, ticker AWC.
There you go. Never heard of them. I have now.
It's essentially a royalty co. It's a spin out of the stake that Western Mining owned in 2002, and it just became a listed, you know, entity owning 40% of AWAC for, you know, and that's been the case for the last 22 years. So they don't do anything. Alcoa controls it, but they have this strategic council whenever a decision is made. So it just adds more bureaucracy for Alcoa of America, the 60% owners, when anything needs to actually get done. So that speaks to the strategic reasoning behind just closing this off and finishing the deal. Like, people predicted this 20 odd years ago. So it makes sense. So getting into what the deal is, you know, the structure of it and everything, it's a non-binding indicative offer. It's a bit funky, which we'll get into. 13% premium to the last close, and they put it as a 19.5% premium to the 12-month average. So they've clearly just tried to pluck out the best set of data to make the deal look good as they possibly can. So it's an all-scrip offer, and there will be 0.02854 Alcoa shares going to all Alumina share for each Alumina share. So it values Alumina at 3.34 billion Aussie, and for reference, Alcoa is in Aussie dollar terms $7.1 billion company. That means Alumina will own 31% of the combined entity. Now, we'll get into this in a lot more detail, but Alcoa, through this Bidco entity, have entered a conditional agreement option for 19.9% of Alumina stock. Now, this is with the money manager, Allan Gray. So like I said, it's just an option which we'll get into. And there's also this 20-day exclusivity period. Directors have announced their intention to recommend the deal, obviously bar a better deal coming through. So in terms of like what AWAC, this JV, owns, you've obviously got the Kwinana refinery, which we spoke about a month ago when it got curtailed. You've got a couple other refineries in WA, a couple bauxite mines. You've got this aluminium smelter in Victoria, and then other troubled assets, San Ciprian in Spain, assets in Brazil, Saudi Arabia, Guinea, and all of that. So let's get into how the deal is actually structured and whether we think, somebody else is going to come through. You can sort of imply from the pretty light 13% premium that Alcoa thinks there's not going to be a competitive bid come through. And Trav, you dug pretty deep on this. The way they've structured it might counter this kind of thinking. What was your takeaway on that?
I actually thought it was pretty interesting how the announcement today, it's like normally you see the announcement of a merger, and what's happened is the two parties have both separately, they've signed a scheme implementation deed. Now that's binding from the point it's on the table, but this isn't an announcement of a signed scheme implementation deed. It's actually just the execution of an exclusivity deed, but they've already mentioned a price or a merger ratio in there, which has seemingly been agreed. Might be in the exclusivity period they might be doing some further DD to justify that. But normally you don't see it announced this way, and normally I'd interpret it announced this way to kind of reflect a bit of a for sale sign on the target entity. This time around, I think there's a bit more nuance given the structuring dynamics. Of note to the deal junkies out there is the way that Alcoa have structured their pre-bid stake in Alumina from Allan Gray. Alcoa has the right to acquire 19.9% of Alumina from Allan Gray's position for the same price as the offer, and the two parties have entered into a share sale agreement as such. You can kind of think of this as a call option, like you mentioned, JD. They've got the right to acquire at a specific price, but it's not a derivative when thinking about the voting rights. This structure, it's kind of a clever way to act as a deterrent to anyone else from lobbing a competing proposal, because it provides a pathway for Alcoa to block it by getting 20% blocking stake just by executing that right. And Alcoa don't actually have to stump up any upfront capital to get the privilege to do so. And so the fact that they chose this structure suggests to me that Alcoa maybe they did have fears that an interloper might pop up. So they wanted to be damn sure to deter them from doing so. Another thing to note is that these shares can be voted in the scheme meeting if that right hasn't been executed by Alcoa yet, whereas if Alcoa straight out purchased the shares and they were owned by Alcoa, they wouldn't have the ability to vote those shares for the purposes of the scheme meeting. So you might be wondering, why the heck would Allan Gray agree to this deal, right? They lock themselves out of any upside if a counter offer pops up. Why would you just, agree to hand them over? Well, don't worry, mate. Allan Gray thought of that one. And you can see if you open up the change of substantial and you look at the share sale agreement there, clause 3.6 basically says that 100% of the upside from any superior proposal, if it comes about, actually has to get passed through to Allan Gray. So, Alcoa would have to pay that as separate consideration onto Allan Gray. So, think about that. Imagine an interloper pops up and they have a 50% premium to Alcoa's bid. Without this clause chucked in there, Alcoa could buy Allan Gray's stake and pocket the 50% gain for themselves, but now none of that upside actually goes to Alcoa. So in some ways, Alcoa actually has zero incentive to play ball to any competing proposal because they don't get the uplift themselves. It goes to Allan Gray.
That's interesting.
Yeah. And so that little fact baked in there might actually further disincentivize an interloper because Alcoa doesn't care how much of a premium it is. They get none of the uplift. It all goes to Allan Gray. So that might deter people even more so if there was an interloper. For reference, I think when MinRes purchased the Wildcat shares from GAM, there was like a 50-50 share that you both get the upside in that share sale agreement. So you can structure it so both entities get some upside, but this one's interesting because, Alcoa would get none of that upside. But all of that contractual stuff might be all for nothing, because it seems to be a deal that doesn't really appear to have a logical interloper anyway. And like, let's take a look at the shareholders you got there. The top 3 shareholders account for 46% of the vote. Those shareholders, on my math, are Allan Gray, which is, you know, a deep value fund with 20% shareholding.
Deep fucking value.
CITIC Resources Australia, which they're a subsidiary of a Hong Kong listed entity that happens to also own an interest in the Portland aluminum smelter in Victoria in joint venture with Alcoa. Now, they have 18% on my count, but their website says 9%. So call it somewhere between 9% and 18%. Not sure which number's right. And then thirdly, Schroeder Investment Management, which is a British asset manager with 8% there. And look, these 3 entities, if all 3 vote for, the deal's pretty damn solid. But remember, it's a scheme of arrangement. So you need 75% of the votes cast to be for and 50% of the voters to vote for. Allan Gray, clearly supportive, in this by executing the share sale agreement already. And the fact that they signed the share sale agreement, I think, is why they actually announced this deal upon the exclusivity deed, as opposed to announcing it upon the scheme implementation deed, because it had to be disclosed. Now, the interesting entity for me, though, in that shareholder group is CITIC Resources. They might make it difficult. I don't know too much about them other than the fact that they have that JV interest with Alcoa in the Victorian aluminum smelter already. Perhaps they'd be an interloper, but would FIRB be too hard? Probably.
So what's the outlook for aluminium, buddy? I'm not too up on it.
I'm keen to touch on that, Matty, but just before, the other bit that I'd emphasise what you just said there, Trav, is the way they've structured it with the option means I would assume that the shares can still get voted. Whereas if Alcoa had just gone and bought them, they wouldn't be able to vote them for their deal.
They can be voted so long as that right hasn't been executed pre the scheme meeting, which ordinarily there wouldn't be the case.
Yeah. So onto the aluminium market, Matty. Aluminium is going to play a huge role in decarb, and it kicked up. There was the price rather has been pretty flat for a long time, although it did kick up a couple years ago. And it's a bit of a different market. 75% of the supply is recycled, which is far more than most metals. However, the production is super energy intensive. When we spoke about Kwinana a month or so ago, we noted that 5% of WA's domestic gas just went to that one refinery, which is just insane to think about. And the Portland aluminium smelter, which we've touched on a few times, is the single biggest electricity consumer in Victoria. So I'd seen reports saying 10% of the electricity in the entire state is used by that smelter, and some reports with an even higher number than that. So the production of aluminium has always been dominated by places where there was cheap energy. And then the last 20 years, China just came to dominate it. They had cheap coal-fired power stations, and that just saw a dramatic increase. Over the last 10 years alone, their aluminium production has doubled. So it's pretty huge. In more recent terms, aluminium wasn't included just last night in further sanctions on Russia, which, kind of like uranium and whatnot, it goes to show the importance to the West of the supply that comes out of Russia from various metals. Aluminium was just one of a few that was included in that. And just to wrap up on the deal, why I think it makes sense. Trav, you touched on there being no logical interloper, and I completely agree. But as to why they're sort of doing it now, I mean, they could have done it any time in the last 20 years. I think there's a specific reason. You can put aside the Strategic Council, which just slows down the whole process of decision making. But Alumina also is constrained by this debt ceiling within the business. It's, from memory, at $500 million, and they're at $300 million currently. And if you think about what's happening in Kwinana and what's happening in San Ciprián in Spain, which they announced last year, you're thinking about much more cash, flows from Alumina into the joint venture as opposed to just dividends being distributed out. Now, that's not what you want from a quasi-royalty company. So the medium-term future, needs a business with a bigger balance sheet to reinvest in all these assets, to make them, revamped and much less energy intensive. And that doesn't really sit well for a company like Alumina, which is just a sort of proxy shareholder meant to distribute cash out. So that really explains why this is happening, at this moment.
Something you didn't think about in the long term, the aluminium outlook, JD. In the last 6 years, I've gone from drinking VB cans and EMU export cans to now having Dingo on tap. So I've myself affected how much aluminium is being used, and probably most other people that have converted to Dingo on tap. So just us small players have a bit of a part as well, mate. Don't forget that.
I could see the smile on your face the whole time I was blabbing on there that you had something smart to say.
Right, Capstone Copper. What's going on, JD? Not getting much love on the course of sales, eh?
No, none whatsoever. But they did come out with their fourth quarter results on Friday, so I thought it was worth touching on. So 44,000 tonnes of copper for the quarter, which is not too bad in comparison to some of the other Australian listed copper producers. They've got 4 producing assets, 2 in Chile, 1 in Mexico, and 1 in the US of A. So their C1 costs were US $2.67 a pound, which isn't great. They did have operating cash flow of 80 million, but if you look at the free cash flow, it's in the negatives because they've been pumping a heap of money into Montevideo, which produced 10,000 tonnes of copper in the last quarter. That's from the oxide ore that they're producing. So they're adding this entire sulfide processing capacity, and that's almost done. That's cost US 870 million. It's set to commission in the next quarter. So a quick shout out to VRIFY. I wanted to see what the hell was going on, and these guys are smart. They use VRIFY, so I could get a good feel for everything going on there.
Love it. I'll take them off the list for Jeremy Raper then. Beautiful.
The scale of the thing is pretty impressive. So it's going off the guidance for the entire company, Capstone. It's driving up their production, in the next calendar year alone to 205,000 tonnes, and C1 costs are coming down 17% to $2.40, and that's not even incorporating a full year of production. Across the whole portfolio, the average grade is going to increase from 0.35% copper to 0.6% copper, which is just huge because they then have increased recoveries, further cost reduction, and then that just flows on in the next year once they've got a full year of the thing under their belt. So, like I said,
from memory, when Capstone merged with Mantos, part of the appeal was the potential for some synergies between Monteverde and Santo Domingo, which was Monteverde was Capstone's development project, and Santo Domingo being Mantos's, and I think there could be some potential for some shared infrastructure between the two and a larger player.
Good
absolutely right. I tuned into the quarterly call. I listened to this morning recorded from Friday, and there was a couple questions on that. There's a few different studies going on at the moment as to like how best to capture those synergies, but this decision to put in almost $1 billion to ramp it up is a decision that's obviously been a long time in the making, and I think all these things just add to an enormous copper producer with multi-decade production mine lives at it. So we'll see how they best tie in those two assets going forward, but I'm sure that's firmly in their plans. Getting into the costs and how they're sort of allocated this, so a bit of a funky one to look out for when you're looking at the C1 costs. They don't include $180 million in capitalized stripping costs. So the stripping costs for these porphyry systems in Chile are enormous. They're on a much, much larger scale than you might be thinking for a gold mine in WA. And going forward on a yearly basis, they gave a rough guide to $50 to $70 million per annum. So just goes to show the low-grade scale of these projects. And they've also got $275 million in sustaining and expansionary expenditures, which also aren't included. So on the back of all of that, they did a capital raise. Now, they said, even in the call, they said, we were fully funded. We didn't need to do the capital raise. So they kept a bit of a straight face in doing that. But they raised over $250 million US in January. But, not the worst time to do it, given that the stock is near all-time highs.
Right. So how does it, what are the peer comps, Mr. Dorling?
So just comparing it to Sandfire is a good one to compare it to. And On 2024, they're both trading between 8 and 9 times EBITDA, and 2025, they're both trading in that sort of 5 times range. They're similar companies in terms of debt structure, in terms of being in a stage where they've had to put a lot of capital into the ground and they're coming out and production is meant to be higher and costs are meant to be lower in 2025. You see that reflected in a lot of research analysts, using funky EBITDA numbers of not the next year, but the year after, or the next 4 years average, those sorts of things. In terms of Metals Acquisition Corp, that one's trading a bit richer. I think that just goes to show the expectation built into it. In terms of debt that I just touched on there, Capstone have net debt of US 523 million, and Sandfire have net debt of Aussie 690 million. So not too dissimilar on that front, which both means, you got leverage plays to copper.
So that's CDI come out in February, wasn't it?
Yeah, I think it was kind of funny. I think the first day of trading was February 2nd, but immediately they went into a trading halt pending a capital raise. So I started to look into the details, because you can see straight up that only 2 million shares were, converted as a CDI to be floated here in Australia, which, even at whatever they trade at $7 or $7.50 isn't an awful lot of liquidity. So I was a bit, curious as to why they hadn't done a bit of a raise into Australia, as they were thinking of floating the CDIs here and getting a bit of traction down under, but it didn't really occur to them. And hence, no liquidity means nothing's trading. No one's incentivized to trade, because they might think, I can't, buy more. I can't sell out of my position if I do get it up here. So it seems like a pretty poorly executed on the surface CDI, and, pointless in the sense that they just have to pay more listing fees. So unless there's more plans to tap into the Aussie market, although I'm not sure they want to dilute more, but maybe someone can fill me in on as to why they would engage in a listing down here.
I think I know part of the answer. I'm pretty sure that so they've done a compliance listing where you list and you don't do a raise concurrently with it, and you get the CDI that way. But I'm pretty sure that if you do the low doc prospectus route, there's like a blackout period of X months where you're not allowed to do a capital raising after it. So this might have been the way for them to list and still be able to do that capital raising they had in the works in the right window. The whole rationale of having an ASX listing doesn't make sense if you don't get liquidity. So they've got to figure out a way to get liquidity.
Agreed.
Well, there we go, boys. It was not many yarns, but
Deeper.
Deep. Just deep, boys.
In depth.
Go and tell you what, go in depth. Do yourself a favour. Go in depth into our show notes and email all of these bloody people, because you won't regret it. Go. It's as simple as that. We're talking VRIFY. We're talking InvestorHub. We're talking DSI Underground, SMEC Power and Technology, McMahon Mining Title Services, Anytime Exploration, and what was his other one? Australian Earth Moving and Haulage. Jeez, bloody Seamus, going off. Hey, KCA Site Services, Brooks Airways. You do it, JD.
And K-Drill.
I like it. Right, Money Miners.
Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.